Hello, everyone, and welcome to AI Explorer Journeys, our podcast where we navigate the world of artificial intelligence. I'm your host, Sarah, and joining me today is my co host, Kevin. Hi, Kevin.
Hi, Sarah. Hi, everyone.
We're all feeling it, right? This sense that AI is absolutely everywhere. It feels a bit like a gold rush. Companies are scrambling, stocks like Nvidia are soaring, and it feels like we're on the cusp of something massive. But whenever something grows this fast, there's always that little voice in the back of your head that asks, is this real or is this a bubble?
That is the trillion-dollar question. And it's a fair one. History is littered with these moments of intense excitement that end in a crash. Think of the railway mania in the 1800s, or, more recently, the dot-com bubble. To figure out if AI is just the latest chapter in that book, experts have a sort of checklist. 5 key indicators to diagnose if we're in a boom or a bubble.
A 5-point checklist, I like that. It gives us a framework. So let's start the diagnosis. What's the first indicator? Where do we look first?
First, we look at the big picture, the economic footprint. Basically, are AI investments so huge that they're starting to warp the entire economy? In the past, when a single sector got too big relative to GDP, it was a major red flag. For instance, at the peak of the railway mania in 1872, railroad investment hit about 4% of U.S. GDP. A year later, the economy crashed.
4% of the entire national economy on just railroads. That sounds astronomical. It's no wonder it all came tumbling down. So where are we with AI today?
Well, right now, global spending on data centers for AI is around $370 billion. That's about 0.9% of U.S. GDP. So, in terms of sheer economic weight, we're not at that insane 4% level of the railroads. It's much closer to the late 90s dot-com era, where tech investment was also hovering around 1% of GDP.
Okay, but the dot-com boom still ended in a massive bust, right? So being at that same level doesn't exactly feel safe. It sounds like we're treading on familiar and, frankly, quite thin ice.
That's a great point. The 1% figure alone doesn't tell the whole story. The key difference today, and this is crucial, is who is writing the checks. A lot of the current AI spending is coming from the tech giants, the Googles, the Microsofts, and they're using their own cash. They're not fueling this boom with massive amounts of borrowed money, which is what made past bubbles so fragile. That said, the growth is still something to watch. Goldman Sachs predicts AI-related capital spending will jump another 17% by 2026. If we ever see that number creep up towards 2% of GDP, that's when the alarm bells should really start ringing.
I see. So the scale isn't at a crisis level yet, and the source of the money is more stable. We'll call that a yellow light then, worth watching, but not flashing red. Let's move to indicator number 2, industry strain. What does that mean?
Industry strain looks at the sector's capital spending versus its revenue. In simple terms, for every dollar a company earns, how many dollars is it pouring back into expansion and infrastructure? If you're spending way more than you're making for too long, it's just not sustainable. Back in 1872, the railroads were spending about $2 on expansion for every $1 of revenue. During the dot-com boom, the telecom and internet companies were even more extreme, peaking at almost $4 of capital expense for every $1 of revenue.
4 to 1. That's like burning money. You can't invest $4 to earn $1 forever. Eventually, the music has to stop. So, where does AI stand on this metric?
You might want to brace yourself for this one. Right now, the generative AI industry is bringing in about $600 billion in annual revenue. But that is supporting a global data center investment of around $3.7 trillion. That's a ratio of 6 to 1.
6 to 1? Wow. That's significantly worse than the historical examples you just gave. That ratio seems incredibly stretched. That sounds like a massive red flag, doesn't it?
It is, on the surface, the most concerning indicator we have. It's definitely an orange, maybe even a bright red light. But again, context is everything. Unlike the railroad companies or the speculative dot-com startups, the ones spending this money are the cash-rich cloud giants. They can afford to have such a high capex to income ratio because they have these immense rivers of cash flowing in from their other businesses. Their capital spending has jumped, sure, but they have the profits to back it up. They are making a colossal bet that AI revenues are about to explode, and this ratio will correct itself over time.
Right, so it's like a person with a massive salary building a mansion. The spending looks insane to an outsider, but they have the income to handle it for now. This brings us perfectly to our third indicator, I suppose, revenue growth. Is the money actually coming in fast enough to justify that 6-to-1 bet?
Exactly. Fast revenue growth is the ultimate antidote to a bubble. It's what turns wild speculation into a justified boom. And if you look at past crashes, the writing was on the wall. Before the 1873 railway crash, railroad revenues had actually started to shrink. Before the telecom bust in the early 2000s, revenue growth had slowed to a crawl, just 0.5% at one point. They were investing for growth that just never showed up.
So how is generative AI doing? Is the growth showing up?
Oh, it's showing up. This is probably the single most bullish indicator for AI. The growth is not just real, it's astonishingly fast. We estimate that this year, the Gen AI industry's revenue will roughly double. That's 100% growth. Compare that to the sluggish numbers from past bubbles. Some forecasts are even more aggressive. Citi predicts the AI model platform segment will grow over 480% in 2025. This isn't a slow burn, it's a wildfire of demand. An IBM survey found that 62% of companies are planning to increase their AI spending. NVIDIA's CEO keeps saying orders for AI chips are vastly outstripping their ability to produce them.
Doubling every year. That's a world away from shrinking revenues. It sounds like the demand side of the equation is incredibly strong, which really does change the narrative around that scary 6-to-1 investment ratio. Okay, so what about the stock market hype itself? Indicator 4, valuation heat. Are investors pricing these companies for a future that can never possibly arrive?
Ah, yes, the P/E ratios and the ghost of the dot-com bubble. That era was defined by absurd valuations. You had companies with no profits, trading at over 100 times earnings. The NASDAQ index as a whole hit a P/E ratio of 72. One analysis found the implied P/E of internet stocks was 605. Investors were basically paying for 6 centuries of earnings up front. It was pure irrationality.
I remember reading about companies like Boo.com, who burned through hundreds of millions on luxury offices and advertising before going bust in months. Is that the kind of insanity we're seeing today?
Actually, no. Things are much saner this time around. Sure, AI stocks have had a great run, but the NASDAQ's P/E ratio is around 32 right now, which is less than half of the dot-com peak. The fundamentals are actually improving alongside the valuations. Let's take NVIDIA, which everyone points to as the poster child of this boom. At its peak in 2000, Cisco traded at over 200 times earnings. NVIDIA, by contrast, is trading at around 40 times its expected forward earnings. That's rich for sure, but it's not the gravity-defying insanity of 200x. There are real, massive, and growing profits behind NVIDIA's valuation.
Interesting. So the prices are high, but they're tethered to reality, even if that tether is a bit stretched. It's exuberant, but not utterly disconnected from fundamentals. Okay, that brings us to the final check on our list, funding quality. Who is financing this boom, and is their money stable?
This is a critical point. Bubbles are often fueled by shaky financing. The railway mania was driven by speculators, loaded with debt. The dot-com era saw a flood of venture capital and IPOs for companies with no revenue. The telecom boom was propped up by mountains of cheap debt. Each had a financial Achilles heel.
So every bubble has its own flavor of dumb money or risky financing. What's fueling AI?
Well, so far, the core of the AI boom is funded in a remarkably healthy way. As we discussed, a huge chunk of the investment is coming from the internal cash flows of big tech. Microsoft, Alphabet, Amazon. These companies are financing this expansion with their own profits. That's High quality, stable capital. It's the bedrock.
That sounds reassuring, but is there a but coming?
There's always a but. The spending required for AI in the coming years is astronomical. Morgan Stanley estimates that between 2025 and 2028, we'll need about $2.9 trillion in data center capex. The big tech companies might be able to cover half of that from their own cash, but that leaves a gap of roughly $1.5 trillion that will have to come from external sources, private credit, bonds, other investors. And that's where the risk starts to creep in.
So that's the potential weak point. When the boom starts to depend on outside money, which might not be as stable or as patient as big tech's own cash.
Exactly. We're already seeing little hints of it. There are stories of startups in the space that are heavily leveraged with billions in debt, relying on just a handful of clients. That kind of fragile, debt-fueled business model is very reminiscent of what we saw in past bubbles. For now, those are the exceptions. The core funding is still solid. But if we start to see more and more of that speculative, debt-driven money flooding in, this indicator could turn ugly fast.
Okay, so let's try to sum this all up. After running through our 5-point checklist, where do we land on the big question? Is AI in a bubble?
Putting it all together, it really looks more like a demand-driven boom than a classic speculative bubble. The economic footprint isn't at a danger level yet. The valuations are high, but not insane. And the funding is, at its core, very high quality. The two big watchouts are that 6-to-1 industry strain, and whether the absolutely blistering pace of revenue growth can be maintained to justify it. Right now, it seems like the fundamentals, the real adoption and revenue, are successfully chasing the optimism. So I'd say we're in an early installation phase boom, not the final, frantic blow-off top of a bubble.
That makes sense. It's like the engine is roaring, but most of the dashboard lights are still green. History shows us the crash comes when multiple indicators all flash red at once. It feels like we're not there yet, but a boom can always turn into a bubble if the hype gets too far ahead of reality.
Absolutely. This isn't a declaration that AI is bubble immune. Things can change. If revenue growth stalls, or if that $1.5 trillion funding gap gets filled with low-quality debt, the situation could deteriorate quickly. We have to remain vigilant.
So the future of AI, is it a golden age of technological progress, or just another historical bubble waiting to pop? It feels like we're standing at a crossroads. Today's analysis suggests we haven't bubbled over yet. There's real innovation and powerful market demand driving this forward. But the lessons of history are harsh. Any technological revolution can be thrown off its rational course by too much optimism and speculative greed. The real test will be whether we can enjoy the immense benefits of this AI revolution while keeping a clear head about the risks that are quietly building. It's not just a test for investors, but for all of us, as we try to navigate this incredible new wave of technology. All right, that's it for today's episode. Thanks for tuning in, everyone, and thank you, Kevin, for the great discussion. Before we wrap up, let me remind everyone today's discussion reflects personal views only, not investment advice. Please consult professionals before making financial decisions.
That's right. Thanks for tuning in to the AI Explorer podcast. If you enjoyed this deep dive, don't forget to subscribe to our YouTube channel. That's all for today. See you next time.